Right now, you probably have a credit card sitting in your wallet. Or, I mean, at least a piece of plastic that says credit card on the front.
Right, yeah, we all do.
Exactly. But if you take a flight to Europe, under their new banking laws, that exact same piece of plastic might legally be considered like an unregulated hidden loan, or, on the flip side, just a basic payment tool that has absolutely nothing to do with credit at all.
Yeah, it completely shatters our standard expectations. I mean, we rely on those labels.
Oh, for sure.
It's plastic, it has a chip, it buys groceries. We just assume it's a simple binary categorization. But from a legal perspective, the label stamped on the front of that card is essentially meaningless now.
That is wild. Well, welcome to another deep dive. Today we are tearing into a massive shift in European financial regulation. We're looking at a briefing on the new EU consumer credit rules.
Yep.
Specifically, Directive EU 2023-22-25 of 18 October 2023, which is on credit agreements for consumers. And for the sake of our collective sanity today, we are going to refer to it simply as CCD2.
Which is a much friendlier name for a very, very dense directive.
Seriously.
And, to understand how this actually hits the real world, we're also looking at how this is being applied locally on the ground. Like, specifically, we're examining Luxembourg's Bill of Law N degrees 8708, which basically transposes CCD2 into their consumer code.
Okay, let's unpack this. Because transitioning from, dense legislative titles like Bill of Law N degrees 8708 into the practical reality of what's in your pocket
is quite the leap.
It really is. So our mission today is to figure out this fascinating legal puzzle. Like, when is a credit card not actually a credit card? And why is a bank software developer suddenly, just as responsible for legal compliance as their actual lawyers?
The stakes are incredibly high here, for both the consumer and the institution. I mean, we are fundamentally questioning the underlying mechanics of consumer debt.
Right.
Before a bank can even update its terms or redesign its app, it has to accurately diagnose what its financial products actually are behind the scenes.
Right. Okay. So looking at the briefing, it keeps using this phrase, natural person acting outside their trade.
Yes.
I assume that just means like a standard consumer, right? Like, we aren't talking about a massive corporation outfitting its sales team with company cards.
That is a crucial distinction, yeah. CCD2 applies strictly to consumers. So if you are a corporate entity buying office supplies, this just doesn't apply to you.
Oh, got it.
But, and this is where it gets highly relevant for, say, private banking, if you are a high net worth individual using a premium metal card to book personal vacations or buy personal items,
then you're covered.
Exactly. You are a natural person acting outside your trade. You are a consumer. And the full weight of these protections applies to your account.
Wow. Okay, so if we're focusing on the consumer, how does a bank actually figure out what the card is? The briefing mentions things like overdraft facilities and overruns. But to be totally honest with you, I always thought those were the exact same thing.
A lot of people do. They sound similar, but legally they are entirely distinct animals. Yeah. So an overdraft facility is a pre-agreed buffer. You and the bank sit down, and they agree you can spend, say, 1,000 euros past your zero balance.
Right. Okay.
And they tell you the exact terms for doing so. An overrun, on the other hand, is when you accidentally spend more than you have, and the bank just quietly lets the transaction go through anyway.
Oh, and then usually hits you with the surprise fee later, right?
Precisely, yeah.
Okay. So one is like a formal agreement, and the other is the bank basically turning a blind eye, but charging you for the privilege.
Exactly. And under CCD2, both of these mechanisms are heavily policed because they're forms of credit. I mean, the overarching legal question is this: does the card use an overdraft? Does it allow overruns? Are there installment repayment options?
Right.
The presence of those specific mechanical gears is what dictates whether a piece of plastic is just a payment tool or a fully fledged credit product.
Okay, let me see if I can put one of the biggest mechanical distinctions into a real-world perspective. Because the briefing spends a lot of time on something called deferred debit.
Yes, it does.
I like to think of a deferred debit card, kind of like a monthly bar tab at your favorite local pub.
A monthly bar tab. Okay, I can see the outline of that comparison.
Hear me out. So the bartender knows you, right? So instead of making you pull out cash for every single drink the moment you order it, they just keep a running tally on a piece of paper.
Right.
They let you make purchases all month long. But at the end of the month, on a fixed date, the bartender expects you to settle up in full. There is zero option to pay half now and half later.
Right, no rolling balance.
Exactly. There's zero interest charged on the tab. You just pay exactly what you drank.
That captures the spirit of the exclusion under CCD2 perfectly. But there is a massive catch.
Okay, what is it?
It only applies if the cardholder repays the balance within a very specific time frame. You mentioned the end of the month, but the strict legal threshold, specifically under Luxembourg's Bill of Law in 8708 and Article 2, Paragraph 5 of CCD2, is exactly 40 days.
Wait, 40 days. So that's the absolute hard limit?
Yes. Let's use the example from the briefing. Say you spend 5,000 euros. If that full amount is automatically debited from your checking account within 40 days,
right,
and absolutely no interest is charged, and there are no fees other than basic payment service fees,
and it's fine,
then it falls outside the heavy compliance burdens of CCD2. It's essentially just a payment tool to settle your bar tab.
Oh, I see. But the moment the bartender says, hey, don't worry about the full 5,000 this month. Just give me 1,000. I'll roll the rest over to next month and add a tiny percentage fee.
Bam. The entire legal nature of the relationship shatters and reforms into something else.
Just like that?
Just like that. The moment that balance rolls over or is paid in installments or accrues interest, that card transforms into an ongoing credit product. It brings the full massive weight of the CCD2 regulatory framework crashing down on the bank.
Wow. Okay, so we've figured out what the card actually is behind the scenes. But how does the bank prove they aren't tricking you into taking on that debt? Because, let's be honest, almost nobody reads the fine print on a tariff sheet.
Right, nobody does.
We just scroll to the bottom of the 40-page PDF and hit accept.
Regulators are acutely aware of that exact behavior. And that brings us to one of the most transformative aspects of this directive. CCD2 explicitly recognizes the reality of the modern digital application journey.
Okay.
Having the correct legal disclosures buried on page 38 of a PDF is no longer a viable defense.
Well, the briefing specifically targets marketing materials and digital journeys. So we're talking about the actual screens you tap through on your banking app, right?
Yes, exactly. The user interface itself, the UI, is now a matter of strict legal compliance. The golden rule here is that a credit feature absolutely cannot be disguised as an ordinary payment service.
Right.
The digital description must perfectly mirror the real financial operation.
Can you break down what that actually looks like? Because I feel like I see offers to pay later all the time, and it always looks so seamless. Like, how do apps currently mask these credit products?
Right. So that seamlessness is often achieved through what we call dark UX patterns.
Dark UX patterns.
Yeah. User experience patterns designed to gently nudge or honestly outright manipulate a consumer. Imagine you are holding your phone looking at a purchase. The app might present a big, glowing green button that says pay in 3 installments.
Yep, I know exactly what you mean.
And right below it, a tiny, dull gray link that says pay in full.
I see that literally all the time. It makes paying in full feel like, I don't know, the wrong choice. Or at least the harder choice.
Exactly. Or consider how annual percentage rates are displayed, the APR. A bank might advertise a 0% introductory rate in massive font, but hide the fact that it jumps to 24% after 6 months behind a tiny little information icon that you have to physically tap to read.
Right.
Under CCD2, these tactics are heavily scrutinized.
So if you are applying for something that can put you into rolling debt, the app interface must make that starkly obvious. Like, the friction, or the lack of friction, is regulated.
You hit the nail on the head with the word friction. For the last 10 years, software developers have been tasked with removing all friction from digital apps.
Right. Making everything a one-click process.
Yes. But consumer protection laws often require friction. They want the consumer to pause, read the costs, and consciously understand the debt they are taking on.
So a bank's UI designers and their legal compliance teams basically have to go to war with each other to find a middle ground. The app can't make signing up for a complex revolving credit line look as casual as ordering a pizza.
Right. It forces a complete alignment. The marketing department, the developers coding the app, and the legal team all have to be singing from the exact same sheet of music, ensuring the digital journey is completely transparent.
Okay, so the app tells the truth, the friction is there, and you consciously apply for the credit card. But CCD2 goes even deeper than that. It dictates how the bank actually decides to give you that money in the first place, right?
It does, and this is where we transition from communication to operational control. Disclosures, no matter how honest the app is, are simply not enough.
Okay.
Articles 18 paragraphs 1, 4, 8, and 10 of CCD2 mandate active, ongoing, and meticulously documented controls regarding a consumer's creditworthiness.
The briefing points out that banks must assess this creditworthiness before granting the credit, which, sounds obvious. But the fact that it has to be legislated implies that maybe it wasn't always happening.
Exactly. The key is the documentation. A bank can't just run a loose internal metric and hand out a credit line. They must document the exact procedures and the specific information they relied upon to prove the consumer could handle the debt.
Hold on, let me push back on this a bit. Say I've been a loyal customer at my bank for 5 years. I've never missed a payment. My salary goes into their accounts. Why do they need to jump through all these procedural hoops and reassess me just to raise my credit limit by €1,000? Don't they already have all my data?
Because your financial reality from 5 years ago is legally considered stale data in the context of taking on new debt today.
Oh, interesting.
Your salary might be the same, but perhaps you took out a massive car loan at another institution last month. CCD2 demands a brand new, fresh assessment before granting any significant credit limit increase. They cannot legally assume you are still creditworthy just because you were in the past.
Here's where it gets really interesting to me. We are living in an era where algorithms run the show. Like a black box algorithm looks at 10,000 data points in a millisecond and spits out a yes or no for your credit limit increase.
Right.
But the briefing highlights a specific mandatory requirement under CCD2, a human element.
Yes. The mandate for human intervention. If an automated system is used to make a credit decision, the consumer has the legal right to demand human review.
Wait, let's really think about the mechanics of that, because the friction there is mind-boggling. An algorithm built on machine learning denies my credit increase. I invoke my right under CCD2 and say, hey, I want a human to review this.
Yeah.
How does a human banker even begin to explain or override a decision made by a neural network that evaluates thousands of hidden variables?
That is the exact aha moment that compliance officers across Europe are currently sweating over. It's the problem of explainable AI.
Explainable AI.
Yes. If a bank uses an algorithm so complex that a human underwriter cannot look at the math and clearly explain why the decision was made, that bank is going to struggle to comply with CCD2.
So wait, banks might actually have to dumb down their artificial intelligence. Like they might have to restrict their algorithms to simpler, more linear models just so a human can legally understand and explain the math if a consumer challenges it.
If we connect this to the bigger picture, you realize this is a massive operational hurdle. It's not just an administrative checkbox. Banks have to build a functional human safety net. They have to maintain the staffing, the training, and the simplified algorithmic models to allow for that human review whenever you request it.
And for private banks who deal with complex client profiles, this has to be a total nightmare. A high net worth individual's wealth isn't always a simple monthly paycheck.
No, definitely not.
It's investments, real estate, trusts. Standard algorithms already struggle with that.
Which is exactly why the briefing calls out priority areas for banks to audit immediately. Premium cards are at the top of that list.
So if you're holding one of those heavy metal rewards cards that gives you airport lounge access and travel insurance, you are exactly the person whose account is currently being frantically audited by a team of lawyers.
Absolutely. Because those premium cards often bundle multiple services. The briefing mentions ancillary insurance wording as a major priority. If a card offers purchase protection or travel insurance, the wording around those ancillary products needs to be crystal clear.
Because they don't want the consumer inadvertently taking on a credit obligation that's disguised as an insurance premium.
Precisely. Private banks have to actively match every single one of those premium card features to its exact legal qualification under CCD2. They have to review the insurance wording, the overdraft links, the limit increase protocols. It is a monumental task of aligning complex financial products with strict consumer transparency laws.
It sounds like an incredibly heavy lift. They are mapping mechanical features, tearing down and rewriting their mobile apps to remove dark UX patterns, documenting their internal algorithms, and hiring human beings to oversee the robots.
It is a profound structural shift, but it forces a much safer financial ecosystem. It eliminates those gray areas where debt can quietly sneak up on a consumer.
So what does this all mean? We've covered a massive amount of ground today. We started with the idea that a card is defined by its mechanical gears like the 40-day deferred debit loophole.
Right.
We looked at how user interfaces on mobile apps are now subject to legal scrutiny to prevent dark patterns. And we ended with the fundamental right of a consumer to bypass a black box algorithm and speak to a human underwriter.
It means the era of ambiguous, frictionless credit is coming to a close. Intention is being forced back into the act of borrowing money. You have to knowingly, clearly opt in, rather than accidentally stumbling into a debt cycle because a green button looked appealing on your smartphone.
Right. And if you are a private banker restructuring a portfolio of premium metal cards in Luxembourg right now, you're living in the trenches of this legal reality.
Without a doubt.
But even if you are just an everyday consumer, this changes how you interact with your money. The next time your bank forces you to click through 3 new, highly detailed screens before approving a simple limit increase, you'll know exactly why. It's this framework at work. It's designed to ensure, with absolute certainty, when you are just paying for your coffee and when you're actually borrowing money.
It shifts the balance of power, or at least the balance of information, back toward the individual holding the card.
It really makes you look at the plastic in your wallet completely differently. And it leaves us with something incredibly fascinating to consider as we wrap up today. We talked deeply about that mandate for human review over automated systems.
Yeah, the human safety net.
It's an amazing safeguard right now. But it begs a massive question for the future of finance. As artificial intelligence becomes exponentially more advanced, and as it becomes more deeply integrated into how our global money is managed,
will it last?
Exactly. Will having a real human being review your financial profile eventually become a rare premium banking luxury? Or, thanks to regulations like CCD2, will the right to look a human in the eye and ask why remain the ultimate undeniable legal right for every single consumer?
It is the ultimate tension between absolute digital efficiency and fundamental human fairness. Watching how global markets adapt to that legal friction is going to be remarkable.
It absolutely will be. Thank you for joining us for this deep dive into the evolving world of European consumer credit rules. We hope you walk away with a little more insight the next time you tap that card or open your banking app. We'll catch you on the next one.